Hey, good evening, everyone. Marty Mazzora here, the 12th of January, Wednesday, 2022. Happy New Year to you all. This is the first video of the new year from us. What I want to do today, folks, is go through several screens. We want to make some technical observations on the S&P 500. And we want to look again at breadth, particularly for the NASDAQ index. But I want to spend a little time on the dollar today and talk about this chart and where we think things are, what our perspective is, what our outlook is, and how that contrasts with some pretty popular opinion on the street. So the US dollar index, and this, we've worked on this chart a lot here on the video, and as you can see, we work on it off the video quite a bit as well. But I've made the comment now for months that if you get the dollar right, if you get inflation right, you're going to get a lot right from a macro perspective as you allocate money in this market. Now, for the dollar itself, in terms of how it's been trending, these wedge patterns, when they're upward sloping, tend to be bearish. When they're downward sloping, they tend to be bullish. And you can see as they've developed, we've had some bearish moves in the dollar, we've had some bullish moves in the dollar and so forth. And when we've looked at this on a more zoomed out basis, I get back to these retracements, these Fibonacci retracements that we set up here before, and basically run it from the peak in the dollar back in March of 2020 to the trough down here. First hit was back here in January of 2021. Now, these retracements are very interesting to look at, and they tend to be pretty good technical indicators, if only because technicians, really value them and will trade on this as well. And we've talked in the past as it relates to stocks, indexes, the dollar, commodities and so forth, about the 38.2, 50, and 61.8% retracements as being key to the technician. So here we had this significant sell-off after the big ramp up around COVID or the COVID lockdowns. And then we began to retrace, and that first real key area is 38.2, as you can see here. We never really quite got to it until the fall of last year, hit it pretty hard, then blew through that, and then 50 becomes key, and then finally the 62%. Well, you can see that the dollar really struggled here with its 50% retracement range, and more recently has come off of that, okay, and is now testing this uptrend and basically just fell below the all-important 50-day moving average, this red line here, which is beginning to roll over a bit, and that's a negative technical sign. So as I've been observing this regularly, and we do a pretty thorough weekly for our own internal purposes, technical analysis of several currencies, and we start with the dollar. We've been noting here that it's really beginning to look weak to us. So here you had a very notable sell signal on the MACD, the moving average convergence divergence, and then you had kind of this downward sloping channel pressing against that downtrend line on the top, and then really falling substantially through the 50-day moving average and right up against this trend line today, right? But we had just a very stark rolling over in the momentum. So we've been anticipating, at least from a technical perspective, some weakness in the dollar. Now, the narrative that's out there, and I just read a pretty thorough analysis and watched a webcast today from some analysts who we respect so much that we pay for a lot of their research. Mostly their geopolitical research is what we're after, but they do, I think, a decent job on other things as well. They are fairly bullish, at least the analysts who presented today, on the dollar. And reading other people's work and so forth, there's a lot of bullishness on the dollar out there. And what everybody seems to keep coming back to is the fact that U.S. yields are rising, right? And so the idea is that if you have a currency that you trust where the yields, related to that currency are rising, the yields in that economy are going up, well, then it would make sense to put money and earn that higher yield. And particularly if you effect a carry trade where you borrow in a currency that's with a very low interest rate, say like the Japanese yen or maybe the euro, and the yen has been your classic for quite some time carry trade, funding currency, where you actually sell or you borrow in the yen, and then you take that money and you convert it to dollars and deposit it in a U.S. bank. And if you're getting interest, or a U.S. Treasury or what have you, if you're getting an interest rate that's higher than the one that you're borrowing in, right, then you can get that interest rate differential, or that spread. And so that action of selling, in this example, the yen, and buying the dollar pushes the dollar up. And we can talk about the currency risk in doing that and so forth. But at the end of the day, it's very commonly believed that that is huge as it relates to anticipation of where a currency will go, that interest rate differential. And some people, from my own observation here of late, that's all they think about. Well, that's not consistent with our study of history all the time anyway. There's been times throughout history in multiple different places where a given country's currency may actually reflect a very low interest rate relative to the rest of the world, and the currency goes up anyway. It could be because their asset markets, equities, for example, may look extremely cheap and therefore extremely attractive relative to the rest of the world. And maybe it's a situation where the sentiment is to buy assets in that country because maybe yields everywhere are low, right? And so in that case, people aren't going to that currency for the higher interest rates because they don't exist. They're going there for the cheap assets that they can pick up. So I'm not really sympathetic in this environment to the notion that the dollar has to go higher simply because the U.S. among developed markets, right now I'm thinking Japan and the Eurozone, being more aggressive and tighter on monetary policy, and therefore yields will be higher relative to, say, the yen and the euro, which is the biggest counterweight to within the U.S. dollar index. When, as clients, as you know, our thesis is that developed foreign markets are probably going to outperform the U.S. market for probably several years right now, is our assessment going forward. And we really think the same thing for emerging markets as well. So if we're right, that would be investors rotating out of U.S. equities into foreign equities. And we've seen that to start the year, but of course the year is not even 2 weeks old yet, so we won't go there just yet. So no, we think that for that reason, more attractive assets elsewhere. The dollar's got some serious headwinds. We also think that there's other real underlying, call them structural phenomena that makes the weaker dollar almost necessary. You really don't want a stronger dollar, particularly if you're thinking about your exporters, right? Also, if you're thinking about all of the dollar-denominated debt that sits on the balance sheets of foreign corporations, a stronger dollar, if it's severe, could lead to major currency crises throughout the world. Now, the Fed has learned that if they open swap lines aggressively, they can quell that, and it worked, I think, beautifully in 2020. So I don't think, we really want, or I don't think the powers that be want a stronger dollar anyway. So I think there's even, call it policy incentive or political incentive or whatever you want to call it, to keep the dollar weaker. And that's our longer term thesis. And that also, of course, is inflation. Now, you can have a stronger dollar and have inflation at the same time. I mean, that's possible. But typically, the two go hand in hand. Now, another thing I want to point out, again, big downdraft in the dollar today, is that futures traders, futures speculators in the dollar, non-commercial futures positions, are net long the US dollar in a really big way in the most recent reading, right? So you got to go back, to, fall of 2019, just for about 3 or 4 weeks, and then back to 2018, and before that, all the way back to 2017, to find people this bullish. So there's a lot of people maybe offsides if we're right. And again, I don't know that we're right in the short run. I'm talking weaker dollar over the next several years. These people are making a bet that those interest rate differentials, I can tell you that's what they're betting, are going to lead to a much stronger dollar. Well, a lot of selling happened in the dollar today at 2/3% move is a really big move in currency in one day, and that's what happened today. So we'll see. And if they are offsides and they start changing their feeling and they start selling, well, then the dollar is going to break through here, and you could get some technical momentum to the downside. The other thing I want to point out is just I want to make that point about this notion that if interest rates are rising in one currency, then the currency should rise relative to other currencies. Well, what I've got here is the US dollar index. That's the mountain chart here in white. The 10-year yield index, and then the, which actually began, this one that they track began in 1994, so I went back to the beginning. And then the zero lower bound of the Fed funds rate in yellow, right? So see my rectangles here, and let me get my drawing tool going here. Right in here, right, you had interest rates rising dramatically, but you actually had the dollar falling during that time period, right? In here, you had interest rates, right? The Fed funds rate, start to finish, you had the 10-year yield rising, start to finish, you had a lower dollar, right? In here, in 2016, when the Fed started hiking, you got, of course, higher Fed funds rate, higher 10-year yield, and right in here, from this point, a lower dollar. And of course, what was happening in 2016, stocks sold off to the tune of about 16%. So yeah, yields were going up, but people were selling US stocks and apparently maybe leaving the currency and bringing the dollar down. More recently, in 2020, you had the 10-year yield beginning to anticipate a recovering economy, some inflation, and so on. So you had interest rates going up, but what do you have? Start to finish, you have a lower dollar. And so that's just an optical or a visual way of looking at it. We can also look at our correlation coefficients, right? We run these on lots of different asset classes. So here's the last 15 years. A correlation of 1 means perfectly correlated. And so the Fed funds rate is going to be correlated to itself at 1. But to the dollar, you can see on a monthly basis for the last 15 years, the correlation is slightly negative. When you look at it on an annual basis, even, you have just very low correlation, 0.05, right? Against the 10-year treasury yield, right? Very low correlation on a monthly basis. Actually, slightly negative correlation on a yearly basis. So when you hear people talk about this interest rate differential, it is, it's very, very widely accepted among currency strategists and traders that interest rate differential is huge. And I'm not saying it's not. I'm saying that at times we absolutely did anticipate a higher dollar relative to yields, but it's all within the context of the global picture and what's going on everywhere, different assets, how they relate to each other. And right now, we could be wrong. In fact, this is one where we may ultimately turn out to be wrong because it's so widely believed that a higher yield means a higher currency. We just don't think so. We think there's other call them headwinds or factors that are prevailing, if you will, that probably make that the wrong narrative right here. But time will tell. By the way, if it is a weaker dollar narrative, if we're right, it's going to be very good, we think, longer term for our commodity-related trades and our equity trades, particularly the ones that are outside of the U.S. But to the extent that we're in the U.S., we do have a very value-oriented kind of a reflation or inflation bias overall, while, of course, being very diversified. And we are actually hedging with derivatives to protect from something big to the downside. So yeah, so I think the dollar is something, I know the dollar is something we're going to pay very, very close attention to, as we allocate our clients' assets into this this future that is, arguably uncertain in a lot of ways. Okay, so for the stock market, here's that familiar S&P 500 chart that we've been working on for years. This is just a 5-year look. As we get these rising wedge patterns and we get these divergences, we tend to get some pain to the downside. Of course, big pain in the spring of 2020. And then at times, when we've had corrections, these patterns tend to precede them. To really zero in here, just on the 1-year daily chart, you've got, I think a legitimate wedgie look right here. You had this triple top. There was a candle formation here that was very bearish. And then the market came right through it, but then fell down back through it, and right now it's testing that triple top here. So you certainly don't want a failed breakout if you're a bull. Those can get really ugly to the downside. We've had some positive action here of late, but we still have these really notable bearish divergences in the momentum. You have, and they're divergences because you have an all-time high, but you're not making highs here in the momentum indicators. I've been really taking into the weeds lately. I'll do it again on the shorter term charts. If we zoom way in on a 60-day, 1-hour chart, the technicals here have been working really well just on the short-term stuff. We're not short-term investors, but I know a lot of you clients out there are looking at your stuff daily. So in here we had somewhat of a falling wedge. I could do this maybe, but you need more points to really have a trend line. And in here we have several tests right there, broke out of it, then failed. And then but that's a bullish pattern. So then the market broke out of that. We had a bullish divergence here in the RSI. Did not have it here, but then we got this buy signal. That's what that is when that white line crosses over. And so here we are, but there's the work to be done yet to get back and to break through these new all-time highs. So if I were a short-term trader and I were looking at this chart, I'd probably look to go short. I might not yet, but I probably would right up here as I see this momentum begin to die off again. And then I've been showing you that 2-hour chart as well. It's going to be a similar look here too. So on the 2-hour chart, more of a channel than a wedge, broke out of it, losing it a bit right here, maybe losing some of the momentum right in here as well. This is a buy signal, so we'll see. I would say I would be neutral right here. I don't think I'd go short just yet. But looking at, again, really zeroing in like on the 6-month chart, folks, this is not a bearish, this is not a bullish look for the market. Could very well break through here and get bullish on some good news. It'll be interesting to see when they sign Washington's quote Build Back Better plan. I think there's one politician for sure who's holding out. I would say, as the cynic I am, he's just holding out for something bigger for his home state. He's got the kind of power that probably comes once in a political career, so you don't want to blow it. But it's a two-edged sword there, because on one end, you could argue that it'll be bullish, and I think it'll be bullish for a lot of the things we're in. But it's also going to be very bullish for inflation. And the Fed is not sounding very soft these days, and the market's allowing them to sound tougher on inflation. So that could exacerbate things a bit. I do think in the near term, just based maybe on base effects, year-over-year numbers, I do believe that we're going to see, in fact, I'm quite confident we're going to see inflation quell a bit over the next couple of months probably. And you're gonna the deflationists, the ones on financial Twitter and who spend a lot of time just denying that we have the makings for structural inflation, are going to be doing victory laps probably when that happens. And it may be good for tech for a while. Longer term, we don't think that's the right narrative based on our assessment of conditions today. Of course, all of that, we're open-minded, and all of that's subject to change. But we've got a ways to go before the signals that are telling us, prepare for structural inflation would change enough to have us change our tune. And then last but not least, this one for you regular viewers is familiar. This is a really troubling chart. This is the NASDAQ Composite Index, and this is that index's advanced decline line. And what I did is I went back about 3 years, and there's a lot of stuff in here that I could put lines on, but the ones that are so obvious, right before the 20% meltdown in 23 for the NASDAQ in late 2018, we had a real signal here. The breath was rolling over when the index was hitting all-time highs, and kaboom, we had a 23.5% decline. And here there was a little decline, but I couldn't really identify breadth. Before the COVID lockdown, the market was signaling that there's some potential pain coming, and that was for the NASDAQ, it was 32.5. It was worse for other indices. Right here before this 11% sell-off, right here before 12%, right here before 9%, and so on. This is a big divergence, and we've seen some weakness. I think the NASDAQ the first week of the year gave back like 4.5%. It's had yesterday it was down 2.5 at one point. It came roaring back on Jay Powell's statement. Today it was up, it was down a bunch. I think it did finish up a little bit. In fact, I know it did. But this basically says, folks, that underneath these close to all-time highs, most of the stocks are actually falling. In fact, the last reading I saw was that 40% of the NASDAQ composite members are actually in bear markets, or they're more than 20%. I think actually more than 40% below their 52-week highs. Something like 60-65% are in bear markets, which are 20% or more below. And when I look at even today's action, and that's follow this third, let me get my tool out here again. Following this, this third line right here, that's the NASDAQ Composite Index, right? Today it was up a quarter of a point, maybe a third of a percent. 1,800 declining stocks. 1,007 advancing, right? The S&P was up a chunk, right? And it was about 40% of them were down. The percent of stocks in the index trading above their 10-day, their 50-day, and their 200-day moving at 73% of the NASDAQ Composite Index, while it's just a hair below all-time highs, 73% are trading below their 200-day moving average. That is not a bullish setup. It's gotten better for the S&P, I will say that. This is a better look. There was a point here not too long ago when we were below 50%, I think, on the 50, and maybe not that far on the 200-day. The Dow, looks okay from that technical metric. So my point here, folks, is a point I've been making for a while, and that is, yes, I get it. We're looking at a market that looks, save for this year so far, right? Looks, continuing to be bullish. People continue to buy all the dips and so on. One last statistic, I don't have it to show you, but I recall this is from someone else did the work, and it was from about a week ago. From the last stimulus check, which I believe was May of last year, to the end of last year, the S&P rose 20%. If you took out your FANG stocks, Facebook, Amazon, Apple, Netflix, and Google, it actually was up 5% for that whole time period. That kind of concentration we haven't seen since right at the tech bubble peak. Again, and I can't emphasize this enough, while it sounds like I'm just setting you up for something ominous to the downside, that's not my intent, because I don't know that that's how this is going to play out. I will say I know, and if you could see me, I'm doing air quotes. The risk is there. The ice is really, really thin in too many spots. And it's too dangerous to do what the world continues to do, and maybe it's already begun, right? And we'll get into this over the next few weeks and months if this continues to look like a real toppy type situation, or we continue to see some of the topping pattern type things that we've been seeing of late in the charts. But there's a famous investor years ago set up this boom bust sequence, and in one of the 8 stages of the sequence, I believe it was stage 6, the point was people continue to play the game even though they don't believe in it. And I think we're kind of in an extended stage 6. And why would people play the game if they don't believe in it? Well, I'm thinking right now professional money managers like us, and institutional money managers that maybe manage in some cases billions of dollars for things like state pension funds and so forth. They are held to task day in, week in, month out on their relative performance relative to each other and relative to some typically all equity benchmark. And there's career risk if you don't keep up with an all equity benchmark like the US S&P 500. I think that's a very precarious setup for their clients, but frankly, if everybody who is, different money managers managing a few $1 billion for a pension account, is essentially doing that, then, if and when the market cracks, they all fall at the same time. And there's not necessarily competitive disadvantage. What we think is the right thing is measuring the ice and protecting your clients against, the potential for thin ice breaking. But you have to be willing to see returns that diverge from a bubbly market that just keeps bubbling up. So we're fortunate to be in the position to be able to do that and feel really good about it from a risk-reward standpoint, and then actually take advantage of some parts of the world and asset classes that are so under-owned that fundamentally offer better value, and from a macro perspective, we think better timing. So if the whole world's playing this, returns game relative to the competition or relative to a benchmark, those of us who refuse to play that game can be early in the areas that these people are ultimately going to be rotating to and running to going forward. So again, we like our overall allocation on a 5-year time horizon based on what we see going on in the world, what we see from a fundamental economic standpoint. But boy, do we see a lot of risk, particularly in equities, and that translates to commodities as well. So we have to hedge against something big to the downside. But we can make money in this environment where there's money to be made. Thank you, folks, as always, for watching and listening. And I'll be back very soon. Take care. Bye-bye.